right, I am on a little bit of a vacation. I'm sitting in a hotel room in Vegas. Just had an awesome breakfast at a Irish pub. You guys do not know breakfast until you go to Ireland or go to an Irish pub that serves breakfast. Dude, that HP sauce, that's crazy. The bangers, the grilled tomatoes, and don't forget the Guinness for breakfast. You gotta get an Irish breakfast, traditional Irish breakfast. So good. Anyways, let's take a look at some stuff today. I'm taking a look at ARM. If you guys haven't heard of ARM, don't you worry about it. ARM is I believe they're a chip maker in UK. Big company. A lot of people in UK have heard of them. They had an initial public offering right here. So 2 days ago, initial public offering. What this means is if you're not a part of the company, you can't buy the shares. If they go public, if they list the shares on a stock exchange, then you can buy the shares. So this is like the first time you could buy the shares, and it usually has a really nice pop out of the gate. Um, ARM is they're supposed to be profitable. I haven't really dug into their financials, but that is not what I'm going to talk about today. What I'm going to talk about is IPOs. I am not a big believer in IPOs. When I was in the industry, I get clients all the time. Hey, this stock is coming out. You think I should buy it? You think it's a good stock to own? And I said, is it an initial public offering? Because I always knew it was. Because there's a lot of hype in them. They said, yeah, it's initial public offering. First time you could buy the stock. I want to go and buy it. And 99 times out of 100, I would say don't do it. Some of them were good, like the UPS one back in the day. That one was pretty good, but for the most part, they're not good. And let me show you why. One is I think they're a cash grab. So this one, let's look at the filing on this one with the SEC. They put out a $51 value off this. So what they do is these companies, Goldman Sachs, Barclays, Citigroup, they all get a piece, and they call their big clients, not their mom and pop clients, not boiler room type stuff. They talk to huge clients, people that want to buy 1 million shares. So they say, what would you buy this at? And the consensus was they would buy it at 51. So they issue it at 51. Now, how many shares are they issuing? At $51, they're going to issue uh, enough stock to get them $4.8 billion. Billion with the B. Now, all these companies down here that are going to be part of this, they're going to make almost 100 million off this deal. Okay? And this is all going to be billed, or this is all money that comes from people that jump into the stock right away. So all these people right here are buying stock from the company and paying those commissions, and they're paying for those the money straight to the company. And then what else happens is people that were given shares, like for working for the company or as bonuses or whatever, at some point, I don't know that, I think it's 90 days. After 90 days, they can start selling their shares, which means there's a selling base right there. You've worked for the company for 10 years. You got the stock at $6, and now all of a sudden it's at 70, and you were chomping at the bit to get your money back out. So let's take a look at some previous IPOs. A couple famous ones here. I'm going to have to go to Google because my charts don't go back that far. So let's look at Snap stock chart. Let's take a look. Let's go Max. Now, Snapchat, everybody's heard of Snapchat. It initially had their public offering at 25, and it came out of the gate at 27. And this, I think this is only a couple days. I think it maxed at 27, and then it just took this dive. Now, it doesn't retest the 27 until not even there. It doesn't retest the 27 until here. So whoever took bought it at the initial public offering in March of 2017, they were not even, they didn't even see the same stock price. They were negative till October of 2020. October of 2020. So that is, what is that? 3.5 years. 3.5 years. This was a complete loss of money, complete negative. Now Snapchat is a bit different. Their financials were horrible. They were losing money like crazy. They have a bad business model. Um, the CEO said they were a camera company. I don't understand. They're not a camera company. Their research and development was all jacked up. It was all going in the wrong direction. And they have heavy competitors. Heavy competitors. They have Twitter. They have Instagram. They have all these other Truth Social, all these other things coming out of the woodwork. They just have a bad business model. Then they blew up here for some reason, and now they're back to nothing. So if you take out this portion here, at no point did it go over 27. If you just take out this year, they didn't get their money back. Let's look at Palantir, PLTR, which I would believe in Palantir. They have a very unique business model. I think they're doing a lot of things right over there, but still, I believe I bought, what is this, 2022? Yeah, I think I bought the IPO actually, because it was only valued at about $10, which that's a good price that I thought for this stock. Now, it immediately went out the gate. People were very excited for this stock. It had this portion right here where everybody was excited, but that's that 2021 rally. So this really isn't fair because that rally was historical. So if I take out this portion here, again, um, it's not as bad as Snapchat because they have a good revenue base and a very good business model, but still, not a lot of growth here. Not a lot of growth here to speak of in the last 3 years. So we're still looking for Palantir to take off in terms of becoming profitable. I think they became profitable a couple quarters ago. They're starting to really rake in those corporate contracts. So I'm hoping to see an uptrend here. But if you invested here at $10, it may have been a decent investment through here, but it just tanked and went all the way down to 5 at one point. So IPOs are very, very tricky. You have to do your homework. You have to know the company, and you have to be willing to wait a long time to get your money back. 99 times out of 100, say no to IPOs.